Hello, and thank you for joining us on the Optimal Wealth Podcast, where we discuss creating passive income through real estate. Our mission is to help educate investors on how to grow wealth and invest passively. My name is Jarod Alexander, and I am a passive investor, currently in 6 syndications as a limited partner. I am also the founder of Optimal Equity Group, which is a real estate investment firm that was created primarily to help educate the passive investor. We do that in a couple of different ways. One is we provide education to help give you the confidence to get into the passive investing space. And two, each episode we will interview amazing guests that explore the strategies, insights, and secrets used by successful investors. Whether you're a seasoned investor or just starting out on your real estate journey, this podcast is designed to help give you the confidence and knowledge you need to make informed and profitable decisions. Welcome to another show of the Optimal Wealth Podcast. My name is Jarod Alexander, and I am your host. And today I'm super excited to have our guest on the show, Chris Seveney. Chris, welcome to the show.
Jarod, thanks for having me today.
Well, thanks for being here. And a little background on Chris. He brings over 25 years of unparalleled real estate experience to his role as a CEO and co-founder of Seveney Investments. Since 2016, he specialized in acquiring and trading mortgage notes, amassing a portfolio of over 500 notes with an unpaid balance exceeding $25 million across various states. So prior to this, Chris's career included managing the construction and rehabilitation of properties worth over $150 million and overseeing new construction projects totaling $750 million. So his dedication to honesty, integrity, and professionalism has made him a respected leader in the industry, driving innovation and excellence within his award-winning teams. And yeah, with that, Chris, I'm just super excited to, dive into your journey, into how you got into real estate and where you were at before too. So if you could, just give us a quick synopsis of your journey and how you got to where you're at today.
Yeah. So again, thanks for having me on today. I've always been in real estate, I guess, is probably the best way to explain it. When I graduated college, I was a civil engineer and started working as a project manager for a large commercial contractor. Did that for 15 years and then went to go work for a developer where I started up a multifamily division for them. So, did that for many years and realized that I needed to start building my own portfolio. Once I was, at this point in time, though, I was in my late 30s. So people, when they think, oh, you got to start when you're young, it doesn't matter, how old you start, as long as you start. And I started building my own portfolio, my wife and I, with rentals. And we're in the Washington, D.C. area, which was very competitive. And it just became too burdensome because of having kids and trying to buy rentals. And I stumbled upon note investing, which I'd always heard about private lending, but I didn't realize there was a whole secondary market where you could buy people's mortgages. So 8 years ago, I started buying my first mortgage note. And fast forward to today, I've bought 600 plus loans in our portfolio and, started out just myself. And now I have a team of myself and 7 others managing a large fund.
Awesome. So, I'm curious on, whenever you had the real estate experience from being in a construction background to new development, right? And then what really motivated you to get into the note lending, the mortgage note space, opposed to multifamily syndications, right, where a lot of us do start to lean towards, just curious on what that motivation was.
Flexibility and time.
Okay.
The interesting thing about note investing is you can do it pretty much from anywhere in the world at any point in time. And to give you an example, you'll get sent a list of, call it 100 assets. And the seller will say, okay, give me your bids by Friday, compared to many other opportunities where if you're in the space, you're always trying to find something off market or, it might be something on market, but it's a lot of times who gets there first in a hot market puts the offer in or it gets accepted. Where here it's more of a, even competitive bidding where the seller's like almost like more like auction style. Hey, I'm accepting bids by Friday at noontime. Give me your bids and I'll take the weekend to review them. That was really kind of the main focus. What reason one, reason two is being in construction, you realize how hard it is to do a good job, and trying to do it if you're remote is nearly impossible. Whether you're trying to fix up a multifamily, you need boots on the ground, you need someone with skills. We built our primary residence and I was here every single day while we were doing that. And even then, you still, had people try and cut corners and, figure things out. I can only imagine being 100 miles or 300 miles away. So being a control freak, that also caused me to kind of shy away from trying to do, the syndication of multifamily nearby. Plus, again, just go back to that competition where, in the area I'm in, I'm competing against some of the largest real estate operators, in the country because of the high cost of housing in the area I'm in. And, the option, the availability of there's not a lot of multifamily, it's more office and other types that, again, a lot of those companies segue towards.
I'm curious. So when you talk about the competition, so you are putting in bids, like, it's essentially an auction, right? To buying these notes. So how's the competition there? I mean, do you get 70% of them or 15% of the ones you bid on, or how does that work?
Interesting. We probably only get about 10 to 15%. But it's not a competition standpoint. It's more of, I'll call it the bid ask spread. Seller is expecting this for, let's just say they want 100,000 for a deal. We might be at 80,000. And, we just can't come to a conclusion. From an actual standpoint of number of people, this is where we feel we've gotten ourselves in a nice little niche, because there's a lot of people who invest in notes who buy a handful a year or may spend up to $1 million a year. Or you've also got these very large, funds or, BlackRocks of the world, who a lot of them are 250 million plus. They're very large. We're floating right now at around 30 million. So we're kind of in between where we can buy from the big players and then sell to some of the smaller players. But there's not a lot of people in between who are looking to take down $2-3 million at a time. People are either looking to take $500,000 or 25 million at a time. So we've created a nice little niche for ourselves.
Yeah. Well, and so what does that process look like as far as like the underwriting, the due diligence on these notes? Because they're sold probably like a package, right? And forgive my, I'm not, too well versed in this. I know we did a little webinar, where you kind of went through it, but just trying to help myself and listeners understand a little bit more about this asset class is, what does that process look like of, again, the due diligence, and if you could just walk us through it and how that works.
Yeah. So first, what we try and focus on are loans that are not paying, the non-performing loans.
Okay.
And we'll look to buy those at a discount. So when we underwrite them, first we'll look at the value of the loan, which is, okay, how much do they owe? What's the property value? And then time is a major factor in regards to, time value of money. And we'll look at the type of state that it's in to see, okay, if we have to foreclose, does it take 6 months to foreclose or does it take 2 years? Because that will have a significant impact. So when we get what's called a tape, which is just a glorified Excel spreadsheet, we will run those through a model to come up with estimated bid numbers based off of a projected return. Let's say we want to make 20% IRR on the asset. We'll stick it into our model and it'll tell us, based off of all the scenarios, this is a number you're going to be at. I'm just going to use numbers. Let's say it's a $100,000 loan. Okay, it's $65,000 is what you got to bid to get to that type of return you want. But you also have to look at, or what we look at is really 3 key components. One is a property. You don't get to go inside the property. So we send somebody by to take exterior photos. Is it occupied? Is the utilities on? Is it well maintained? Now, if you drive by and it's boarded up in 3 foot tall grass, that's probably problematic. We like properties where the person is living still in the property. Now, the other component to the property is, are they paying, are taxes being paid? Typically, if someone's not paying their mortgage, they're not paying their escrow, so they're not paying their taxes. Are there other liens on the property? Are there other mortgages on the property? So we'll start looking at that picture because we like to buy what's called first position liens, meaning we're first in line. So if there's other mortgages, they're behind us and we're kind of in the driver's seat. I like to use the example of being a train. We want to be the front car on the train, not the caboose. So we'll look at that. And then we'll also look at the person themselves in the sense of we'll do what's called skip trace, which is like a background check on them. Have they filed bankruptcy 5 times? You've heard the term professional renters in the past. There's professional homeowners, people who know how to game the system of not paying a mortgage. Do they have a criminal history? Could be they've been arrested for drugs many times, or we've seen, you name it, we've seen it on a record. And then last, we'll look at the predicament. And that kind of ties to the person as well in regards to most people really don't wake up one day and say, I'm going to stop paying my mortgage today. No, we look to buy loans where, a person got into a hardship, whether it was a divorce, a death in the family, a short-term disability or health issue, or job loss. What caused them to stop paying, and has that been resolved or rectified? And we get to look at all that information because when we get the package, they have what's called the servicer notes or all the comments, which is like the diary of all the conversations back and forth between the company collecting the payments and the borrower. So we, have all that information at our fingertips to try and look at, is this a loan we want to buy? And I'll give an example. I've had loans where the person murdered another person, didn't want to deal with it. Right. We've had ones where it was a woman whose husband passed away and she had 5 kids, and unfortunately, that wasn't a loan we wanted to buy because we didn't see a way we could help that borrower. And if we can't help them, maybe somebody else can, because I didn't want to put a woman with 5 kids, foreclose on their house because she couldn't afford it and she had to go through already this heartbreak that she's had. And other people have different models that could help them. So, there's different scenarios that we have to map all this out.
Yeah, no, that makes sense. And yeah, thanks for walking us through that. Because, it's easy just to look at the investing side of it from our point of view. But I mean, going into, these are actually people's lives here. And, you don't want to put a woman with 5 kids out on the streets if you don't have to, right?
Yeah. Yeah. And one thing I'll mention too, because people always say, well, what about your investors? And the way we model our loans, I'm going to throw a number out there, but it's, not an exaggeration, but I'm spitballing it. Probably 80 to 90% of the time, it's better for us to work out some type of new payment plan with the borrower than it is to foreclose on their house, because it goes back to what I said earlier. You've got that time component. If I can get somebody, because we're buying it at a discount, to start making some payments to try and get caught up, then recast the loan or basically modify the loan and sell it back on the secondary market to people who buy these performing loans, we probably make close to the same amount, but in a much shorter time frame than holding these things for 3 years. So our model really focuses on trying to work with the borrowers, and we can't do it every time. We do occasionally have to foreclose, which is probably about 10% of our portfolio. And it's usually at that point in time because the person either doesn't want the property or they're deceased.
Well, and I would assume the good news is too, I mean, if that is the case, I mean, of course you would rather them, still making work out a payment plan. But if you do foreclose on it, I mean, you have the real estate background, right? And the construction and on the development side where you can either fix up the house or sell it, quickly, make a profit and then move on, right?
Yeah. And in today's economic environment, we've rarely ever fixed up properties. And the reason why is, look at any residential real estate person, everybody is begging, kicking, and screaming to find some off-market properties.
Yeah.
So, we'll put it on the market or it's a rehab. And, for us, people are paying top dollar for investment properties. So, we won't put a penny into it. We're like, here you go. And, today, 5 years ago, it was a little different where we do some light rehab, but the last 24 months, we haven't had to. In the future, probably have to start because I think we're, housing's starting to, sag a little bit. Might have to put some money into them, but, haven't had to, which is good.
Yeah. Yeah. No, that is a good point too. And now, going back to the investor side of this. So, I was telling you before the show, I mean, I've had a lot of different guests who we've focused on the multifamily value add space.
Mhm.
We talked about new development, self-storage, oil and gas, debt funds, things like that. So, as an investor, experienced or just getting started out in this space, and as we're, looking at the level of, the risk, right? Obviously, we want to mitigate risk as much as we can. And then looking at the returns. And of course, it depends on where you're at, what type of investor are you, cash flow or growth, right? If you're just trying to build net worth, and you can be both as well, but definitely depending on your goals. So I'm going to give you two questions here. First, what level of risk tolerance, and this can kind of maybe go into your experience too of your track record up to this point with note investing. But if you could, touch on the risk tolerance and what does the returns look like for investors?
Yeah, so great question. And to answer that, part of the first question is, we're an income play. It's not a growth play. It's an income play for people looking for monthly cash flow. From a risk profile, I look at, some of, and again, there's risk in every real estate type of investment.
Yeah.
Where we like to look at our risk mitigation strategy is we don't have debt. We don't have a bank loan or any other type of debt on our books, which other types of investment products, might leverage 50, 60, 70% of that asset. And by doing so, for me, and this is just my personal opinion, when you add leverage like that, you're adding a component of risk because if the value goes down, then you could potentially, lose part of your investment. So for us, we don't have that debt component. So I would say it's a lower risk and again, that's just my opinion. Now, on the return side, the returns are between 8 and 11% that we provide annually. And similar to, it being an income play, it's not as, you go to a multifamily deal. Yeah, you can get teens and higher double digits back to, again, it goes to what we look at that risk component or a risk profile. So I like to use the term, slow and, kind of slow and boring. I'm at an age now where we just came back from Florida and there was, what's the pool that you sit on the raft and the lazy river. Yeah. So, that's what I like to say is I'm the lazy river guy where I just want to sit and just cruise on the lazy river. And sometimes, you might hit the walls or whatnot, but, you're not going, up and down the roller coaster ride that you might with some other investment. So, that's kind of what we look at from our risk profile is, I'm not trying to compete with a multifamily product because that's a growth play. We look to compete with the other income plays and try and, be as risk averse as possible. And one of the major ways we do that is, again, by not bringing on any debt.
Yeah. Yeah, no, I love that analogy about the lazy river, and just had a thought too. Is kind of where I'm at, and my investing career and just in life in general is I'm at the amusement park and we're going on the roller coasters, and my poor wife, she's going with me, right?
Yeah.
And we're going up and down, and then we do venture over to the lazy river every once in a while. So we're kind of in all aspects of the park, but I think it's, going back to what, where are your goals, where you're at in life, right? What stage and, what's your risk tolerance, with what you're doing. And I do like, and if you could, because I remember you talking about this as well. So we got the 8 to 11% returns. if I remember correctly, typically that pays on a monthly basis. You pay pretty much dividends, right? Because they're essentially shares of the company, and that investment is for the most part tied up for about 4 years, right? Is that accurate?
Correct. Yeah, it's a 4-year investment, 4-year hold period. You are buying shares into the company that we issue. When you invest in a company, it's not you're investing in a single asset, you're investing in the entire portfolio of the company, from that standpoint. So it's if one deal goes, one note goes bad, you're not tied to that, you're tied to the overall portfolio. Pay those distributions on a monthly basis. And like you said, after 4 years, you can stay in, you can stay out, you can, take half out. It's completely up to the investor at that point in time what they're looking to do.
Yeah, and then you structure these a little different than like your typical syndication, right? Where it's a 506B or a 506C, where it's accredited only or non-accredited base. So, what if you could touch on that a little bit? And also, I think it's important to touch on how you can invest, because a lot of using like solo 401ks or self-directed IRAs is a great strategy to build some income as well and get some cash flow for your retirement. Touch on that, the benefits, talk about UBIT and some things like that too.
Yeah. So, I don't know if I'm an idiot or a genius, but I say that because we did what's called a Regulation A+ offering, which allows for accredited and non-accredited. And we went this route because I had a lot of investors when I was doing other funds who were interested in investing, and they had, $10, $20, $30,000, but they didn't have that accredited, qualification. So by doing what we did, Regulation A allows us to do, again, the non-accredited as well, but we have to submit everything to the SEC, and we have to have annual reporting to the SEC. We have to have audited financials. They qualify the offering. They don't approve it. They don't approve anything. They qualify it, meaning that the way I interpret is it meets their terms. Now, by doing that, again, then we can accept, like you said, solo 401ks, IRAs. And because, again, we're a C corporation, I can't provide tax or legal advice. But being a C corporation, that is my understanding is the UBIT blocker, because we're already paying corporate taxes. So there is no chance of the UDFI or UBIT. Plus, we also don't currently have any debt on our books, which is where that comes into play. But even if we took on debt, you still wouldn't have to worry about that. The other thing we've recently also been able to do is work with Schwab and a few other platforms where if you have a brokerage account with a investment advisor, they can also invest in our fund. Now, if you just open a Schwab account your own, they wouldn't allow it. But if you work with somebody, have an investment advisor, and I can't think of the term right now, I think it's called a brokered account, then this offering is actually accessible for them as well. So if somebody doesn't want to, invest in all of Schwab's products as an example. We're working on like Fidelity right now as well. And let me just tell you, getting on some of those platforms is pretty challenging.
Yeah, I bet. And there's probably a lot of hoops you got to jump through. I would imagine, huh?
Yeah, I can't tell you how many times in the last 24 months that I've had to go through some type of background check or fill out paperwork to have every type of background check ran against me.
Yeah. I bet. Well, and that's interesting because I didn't know that because I actually have a Charles Schwab brokerage account, but you do have to have a financial advisor as well to be able to invest, because they would have to make the initial investment, right?
Yep. And typically again, I think they may have to do like and again, this is way above my pay grade. Right. Do they need to do additional due diligence or on it? That's, between you and them. Yeah.
Well, no, yeah, I think that's, just awesome. And thanks for going through that again, because and I just want to highlight something again. I'm not a CPA, like Chris said, we're not giving tax or legal advice here, but I will share, that, I mean, with the way they have these set up with the Regulation A and investing with a self-directed IRA, not having to worry about this UBIT or UDFI, I believe it is, or something like that, that you're not subject to tax. I mean, it is the capital gains do grow tax-free. And when you are looking at doing, say, it's a multifamily value add investment, like Chris had mentioned, with the debt that is acquired on that property, I think, Chris, what is it, 50% or more that you're leveraging, with a loan, then you are subject to this, UBIT tax, which means your self-directed IRA, even though essentially a lot of times you get that because you're paying no taxes on the money that grows, you are subject to some taxable income there. Now, when looking at it over a bigger picture, it's very minimal to some of the returns you can get, say in a multifamily syndication, but it's something to pay attention to. And, investing with someone like Chris is a great strategy for one, to avoid that altogether, and two, to create some good, cash flow on your retirement investment. So yeah, I think that's yeah, go ahead. Yeah.
And two things too, like I'm an investor and, I invest in growth products like multifamily and I invest in income products. So it's not like one is better than the other. It's like anything, you want to diversify your portfolio.
Yeah.
The other thing we tried to do, because we also have non-accredited, is our minimum's only $5,000. So a lot of times people might not have 50,000 or 100,000 like these multifamily deals require. You might have, just getting started with a self-directed IRA and you put your $6,000 minimum, or it's 3 years old, might have 10, 15, 20,000 in there. Okay, we're another option, that they can invest in, where you might, if you don't have the full funds, and the other thing that's good about sometimes like a debt fund is, for me, I like to use my cash on the multifamily deals because I also get the tax benefits of depreciation and some of those, where if you're using your self-directed IRA, you don't get that, whereas if I take my self-directed IRA, put it in a debt fund, well, we, in our note fund, we don't have depreciation because we don't own real estate, we own the loans. So it also kind of use my cash to get that depreciation, but also use this. So I'm also not getting taxed on it as well. So it grows tax-free. Plus, I call it a double whammy of I'm getting depreciation with my cash and not getting taxed on the self-directed IRA.
Yeah. Yeah, no, that makes sense. And then, having a $5,000 minimum, you can, you can just kind of put some money in, see, make sure everything's going as planned, of course. And then I would imagine, Chris, you get a lot of repeat investors too, right? They kind of test the waters a little bit just to see how the fund works. And then,
yeah, we're at the end of the month. And I think for like this month, 50% of the money that came in the door was from reinvestors. Yeah, we have a good reinvestment rate. And like you said, people start with like 5,000 and then realize, okay, we, we do what we say we're going to do. And that's the one thing we're really big on is communication, just doing what we say we're going to do. And then they're like, yep, they did what they said. And then next thing, they'll go from $5,000 to $25,000 or $50,000. So they'll, stair step that investment where they'll start with something to see whether it's legit and then continue to invest.
Yeah. Well, and I'm going to throw this question at you here because, again, like I mentioned before, we talked about debt funds as well, right?
Yep.
So I'm curious on, I know these deals are structured different. Typically, debt funds are 506B or 506C, actually, mainly. But you can get typically between 8 to 10%, sometimes higher on a debt fund as well. And it's typically, most of them are more liquid, within 90 days or so, or sometimes even less. So what is the main difference between a debt fund and investing in a note fund like yours? Just a different asset class, or is it?
It's a few. Usually the debt fund is structured in an LLC, so the taxes are different where you're getting interest income, so you're usually getting paid that ordinary income rates compared to, again, not tax advice, but usually we issue a 1099 dividend, which dividend income or qualified dividends today are taxed a lot lower than ordinary income. So you look at, if you're in that top tax bracket, if you make $10,000 in interest, you're paying 37% in taxes, you're netting 6,300. Where if you made, 9,000 in ours and only paying 20%, you're paying 1,800, you're getting 7,200. So you'd actually make $1,000 more at the end of the year because of, people need to understand there's gross and net. And what we see is most investors only look at the gross. They always never look at the net. And, it's hurt us, honestly, because we, explain this, but sometimes people don't see it. The other is really the asset class. Most debt funds are either investing in multifamily or doing like short-term private lending. Now, for us, we do have some shorter-term interest-only loans to provide cash flow as part of portfolio along with our non-performing loans. But it's really a mix of that diverse portfolio. And, we're more focused on, having that diverse portfolio versus, like, I know one debt fund, they've got 3 assets in the fund and they're all multifamily that are the $30 million fund. It's very similar to our size, but they have 3 assets that are all 10 million apiece. It can go really well, or, we know what's happened with multifamily lately. It, could go really bad. So we, at any point in time have between, call it 50 and 150 assets in our portfolio. So, the type of asset, the diversity, it's different. It's no, the way I'll look at it is, even take multifamily. There's Class A multifamily and Class C multifamily. It's a very different management, it's a very different investment strategy. Very similar to like our fund versus a debt fund. Not saying one asset class is better than the other. They're just different.
Yeah. Now, would you say, again, in your opinion, as far as the risk tolerance goes, like note investing, you think you would mitigate risk a little bit more than a debt fund because you're not leveraging debt?
Yeah, and that's the other thing that I've seen some debt funds do is they had investors, but they were getting loans. They have lines of credit that were at the time were paying, call it like SOFR plus 5. And what they're doing is they were originating, these private lending loans at the time at like 9%. And they were doing a 5-year loan at 9%. And all of a sudden, 2020, 21 hits, the SOFR goes from 0, they were paying 5.5% for that money and lending it at 9. Now they're paying 10.5% for that money, but it's still being lent at 9%. So now, they're upside down. And they're more just like any type of debt, you're susceptible to interest rate risk. And for us not having that in our fund right now, we're not susceptible to it. So, of course, my opinion is going to be, yeah, mine's better. But
Right.
I think I have a valid argument to say I don't have the debt. So that's one less risk factor I have to deal with is the variations in interest rate, or having to pay that increased debt service if interest rates fluctuate.
Yeah, well, and I asked that question too because obviously you're gonna lean towards the note investing, but you're an investor as well, right? And I think it's important for investors as a whole to really look at the pros and cons of both and really determine again what works best, what risk tolerance and just what the goals are and to getting the returns they're looking for. But no, I think I told you this on the webinar too. I really like, the route and the structure for one with the Reg A. And I'm curious too. So with that being that non-accredited and accredited can join in on these, investments, is there any sophistication or any process you have to go through to make sure the investors are sophisticated, or is it just kind of, hey, here's what it is, or do you want to do it or not type of deal?
Yeah, so there is no sophistication requirement, and the reason why that's not required is very similar. Like if you want to go buy Microsoft stock, we have to publish 30 pages of risk factors and this 100-page offering. A prospectus is basically what we have to provide. Now, if you're non-accredited, it does limit the amount they can invest, which is 10% of their annual income or 10% of their net worth. So a non-accredited investor can't say, I'm worth 100,000, here's $100,000. Now it's self-attestation that we don't, verify that with them. The only things we have to do, or which we do, is we do what's called an AML KYC check, which is anti-money laundering and know your customer. And if you invested today, your money would sit in an escrow account until they run you through the, I don't know, whatever FBI, whatever check it is to make sure, that you're not a European drug lord or you're not an arms dealer in a foreign country. And believe it or not, actually, we had somebody who tried to skirt around investing and wanted to kind of invest on the side. And when we Googled the person, they spent 20 years in prison for being a drug runner. So
wow. Okay.
interesting enough. So that's really the only thing that we have to check. And I know there's the whole, BOI thing that's going out where you got to fill out this form to say beneficial ownership of your entity that I know everyone's like flipping out about, that I think FINRA or somebody is requiring every entity to do. That's really all it's for, is they want to know who's running these companies because they want to basically make sure, nobody's, filtering money or laundering money is really the only reason.
Yeah, no, that makes sense. Okay. Yeah, no, it's great information. And, and I would encourage anyone, that's listening to this to reach out to Chris. And at the end of the podcast, we'll put some, we'll put some links in the show notes, but Chris will tell you where you can find him to learn more. But in the meantime, Chris, what we're going to do is transition into what I like to call the fire round here.
Yeah.
All right. And I don't know if you saw these questions here, but we may be just right off the cuff on some of these for you. I forgot to mention it before we started the podcast, but
I did read the questions.
You did? So, okay, cool.
Yeah.
All right. Well, so the first question, if you could recommend a book on real estate for investors just getting started out, and then another book that's particularly good for cultivating a positive mindset.
I'm going to go really off cuff on the book because, everyone probably says Rich Dad, Poor Dad, or, any of the types of those books. The book I'm going to tell people is called Real Estate Finance and Investments. And it's actually more of a textbook. And what it walks through is the financial side of real estate and understanding debt, understanding leverage, understanding cap rates, IRR, because everyone always focuses on, I want to go buy a pretty house, or I want to go buy this, or I want to go buy that. And they have no idea about the numbers behind it. So this book is, I believe it's a college textbook that literally they use in like grad school level, but it breaks down chapter by chapter in different types of investing, multifamily, single family, self-storage, if you're doing mortgage-backed security, like every different thing, and outlines all the terminology so you can understand the differences in, I want to buy a small multifamily. It's a 5% cap rate and one's at a 6%, but the 5% has huge capex that's needed, maybe the 6 is better, maybe it's not. So really great book. The author is Guy Brueggemann, and there's like 20 editions. And I'm never going to tell anyone about piracy of things, but the 15th, 16th, 17th, and 18th edition is online for free, but you got to pay for the 20th edition, I believe. And I don't know, once you get to the 20th edition, how much can change when it comes to, understanding cap rates and stuff.
Right.
And then kind of mindset, a book I really like is Traction by Gino Wickman. And really the whole, EOS system and operating in a structure. And I find most people fail because of consistency. And this book gives you a mindset of how to maintain consistency and how to put systems in place to maintain consistency.
Do you use the EOS in your business?
Yes, we do.
Nice. Yeah, great book. I've read that one. And thanks for recommending. Yeah, because you're right. A lot of people just recommend Rich Dad, Poor Dad, or, some of the other, famous ones. But yeah, I'm actually going to check that one out myself. So yeah. So next question here is if you could share a specific goal or dream that holds special significance to you.
Yeah, for me, it's, starting my own business. And, people, I get asked a lot when people say, like the 7 and the E, what's it mean? And people like, it's my last name. And people like, oh, I get it. But, it actually goes back further than that, where, when I was probably like 7 or 8 years old, we had to do a coat of arms in art class, and I was horrible at art. And my father's like, oh, take our name and do the 7 and E and make it like a little Superman logo is what we originally did. And, to me, and I lost my father going on 5+ years now, when I was able to start my company, unfortunately, after he passed away, first thing I thought of is I wanted to go after, use the 7 and the E, because just, family and tradition means a lot to me. And to be able to, start my own company and run my own business is a goal and a dream that I never thought I could do. And honestly, I always thought, and for anyone who's out there, it's not how smart you are in regards to starting a business. It's having the courage is really what it boils down to.
Yeah, no, I love that. And I have a lot more appreciation of like you starting your business, and I'm going on 2 years of starting mine, and just the level of commitment, the ups and downs, the long nights. I mean, it's a lot of work. It really is. But it like for you, Chris, is definitely well worth it for sure. And it's encouraging to hear that. So yeah, thanks for sharing that. And if you could tell the listeners, how do you structure your day to maintain a healthy work-life balance? So do you have a morning routine that you can share with us?
This is the hardest part of every entrepreneur, is that whole work-life balance, because it's really a work-work balance. But for me, a few things. One is surrounding yourself with people around you who you trust. And my morning routine now is I wake up in the morning, I've got kids, and, get them ready and stuff. I'll start my day, usually start it early and come grab a cup of coffee and just come in front of the computer and just answer some of the emails, get some of the simple stuff, off my plate. And usually while I'm doing that, I'll actually be on a walking treadmill, trying to get, a few miles in early in the morning. And then I'll try and go work out. Either, I can work out at home. There's a local club that we belong to that I also like to, at least 2 days a week, they have indoor golf simulators. So I can just go play a round of golf in a simulator, or go hit a round of balls, so I try and maintain that. The other thing is small things during the day. Go for a walk, 20-minute walk during the day, just to clear your mind. Take a lunch break. I can't tell you how many entrepreneurs, including myself, skip every meal during the day and realize it's 7 o'clock at night and like, oh, maybe I should eat something today. And then the other is disconnecting. A lot of entrepreneurs work from home. Disconnect once you go spend time with your family. Put the electronics down and spend time with your family, because at the end of the day, they are who is most important.
Yeah, that's why we're doing everything we're doing, right? To just to be with the people who matter most. All right, and this last question here: if you could be remembered for one thing, what would that be?
For me, it is kindness. I believe kindness has the power to positively impact people's lives and create ripple effects as well as goodwill. So for me, it's, if somebody asks me, or, I'm always trying to, lend a helping hand to people, and so forth. And, from that standpoint, I'm also the type of person who I tell people the truth. I'm not going to sugarcoat something. If I see somebody who is an example is, hey, I want to get in real estate. I'm thinking to go buy this 8-unit property in this area. I've never bought real estate before. I'll be flat out telling my family, I think you're nuts. Here's a reason why. And, just like trying to fly, if you're going to go fly an airplane, you're not going to get on and fly a 737 the first time around. You want to get some type of education, and you're going to fly a little prop plane. I tell people, own a property first, own your own property, understand what it takes to maintain it before you start going nuts and start buying everything under the sun.
Yeah. Yeah, no, that makes sense. And I love that, going back to just that kindness too, and I think that creates that ripple effect in our kids as well, right?
Yep.
They watch what you do, not what you say. It teaches them how to treat others too. So no, I love it, Chris, and thanks again for coming on the show with us today and sharing
Mhm.
all the insights
Mhm.
and if you could just tell listeners where they can go to find you to connect.
Yeah, they can go to our website, 7einvestments.com. That's the number 7, then the letter E with investments after it.com. If you're interested in investing, you can email us at invest@7einvestments.com. And yeah, that's the best way to reach out to us.
Awesome. Well, yeah, we'll put that in the show notes and thanks again, Chris.
Jarod, thanks for having me.
Thank you for listening to the Optimal Wealth Podcast. If you enjoyed this episode, please be sure to rate, review, subscribe, and pay it forward by sharing with a friend. Most importantly, be sure to optimize your results and take massive action on what you have learned here today. For more, visit optimalequitygroup.com.